All right, let's talk MasterBrand. The company just reported its Q3 earnings, the stock got absolutely hammered, and we're going to dig into the numbers to figure out exactly why and what might be coming next. Okay, let's just cut right to the chase. This number right here, it tells you pretty much everything you need to know about the market's gut reaction. The day after the earnings call, MasterBrand's stock just fell off a cliff, down over 14%. So yeah, what in the world happened? The story of this quarter is really all about these deeply conflicting signals. If you just look at the report on the surface, it doesn't seem like a complete train wreck. But the market clearly saw something it really, really hated, and that's what led to that massive sell-off. Our job is to figure out what that was. And here it is, the central puzzle, all on one slide. On the left, revenue, a solid beat. They brought in more than $20 million ahead of what analysts were expecting. You love to see that. But then you look to the right. The bottom line, a miss. Adjusted earnings per share came in 3 cents shy of the consensus. So what does that tell you? It's simple. They sold more stuff than expected, but they were a lot less profitable doing it. And if there's one thing Wall Street hates, it's shrinking profitability. That whole profitability problem really boils down to one thing, a severe margin squeeze. To understand why those earnings missed the mark, we've got to look at how their profitability changed. So let's get into the numbers. Wow, okay, this table really paints the picture, doesn't it? Gross margin fell by 190 basis points, or BPS. Now, 1 basis point is just 0.01%, so we're talking about a 1.9 percentage point drop. That's huge. And it's a similar story with their adjusted EBITDA margin, down 160 basis points. In plain English, this means that for every dollar of cabinetry they sold, their core profitability was significantly lower than it was just 1 year before. So what went wrong? Well, to their credit, management was pretty clear about the culprits. First, new tariffs on things like lumber drove up their costs. Second, because sales volume was lower, all their fixed factory costs were spread across fewer units, which makes each one less profitable. Third, demand was just soft in their high-margin channels, like retail and dealers. And finally, the sales they did make were skewed more towards that lower-margin builder channel. It was basically a perfect storm for compressing their profitability. Now, despite all of this, listen to how the company's CEO framed the quarter. He called it disciplined execution. And look, you can argue they navigated a tough market, but there's a huge disconnect between that statement and a 14% drop in your stock price. The market's verdict was clearly much, much harsher. So, with the core business obviously under a lot of pressure, what's the long-term plan? Well, management is pushing all their chips in on one massive strategic bet. And that bet is a merger with their competitor, American Woodmark. This is the company's big answer to the current challenges. The idea is to combine the two companies to create an industry behemoth, one with more scale, more efficiency, and more pricing power. $90 million. This number is the big prize. It's the target for annual cost savings, what they call synergies, that they expect from combining operations. Honestly, this number is the entire foundation of the long-term bull case for the stock. But, and this is important, let's look at the timeline. While the deal is expected to close in early 2026, realizing that full $90 million in savings is a long-term project. As you can see, they don't expect to hit that full run rate until early 2029. So this is not a quick fix for the margin problems they're having today. So we've seen the problem from Q3, and we've seen the company's long-term bet. Now for the most important part, what happens next? Let's get to our final call on Q4 and beyond. So after all of that, what's the call? Here's what we're watching for next quarter. All right, here's our forecast. For Q4 revenue, we're actually calling for a slight beat versus what the street expects. The company's guidance for flat sales for the full year implies a pretty strong fourth quarter to make up for earlier weakness. But, and this is the big one, we're forecasting EPS to come in below the low end of their own guidance. The rationale is simple. Management explicitly called out a $20 to $25 million unmitigated tariff hit coming in Q4. That's a massive headwind. This will likely lead to some volatile and range-bound price action as the market tries to balance that near-term pain against the long-term promise of the merger.
This all brings us to our final rating, market perform. The long-term value creation from the American Woodmark merger could be significant, but it's a long way off. In the immediate future, the business is facing severe margin pressure from tariffs and a difficult housing market. For us, the risk and the reward feel pretty well balanced right at this level.
This is not financial advice.